What is going on, guys? Welcome back to another video. My name is Felix and I hope you guys are having an amazing day. I know I am, because today we have a special video talking about my top 3 stocks to buy for investing June 2020 edition. Now, before we start,
just a disclaimer, I'm not a financial advisor. The information contained in this video is for entertainment purposes only. Before investing, please consult a licensed professional. Any stock purchases I show in this video should not be considered investment recommendations. I should not be held liable for any losses you may incur from investing and trading in the stock market.
So make sure to smash that like button and subscribe to this channel if you haven't done so. And by the end of this video, you'll have a full understanding and breakdown analysis of each of these companies and which one to invest in. Before we start, what I like to do in the beginning of each of these stock videos is show you my current position as to date. Rather or not, I'll be exiting or adding into these existing positions based on current economic standing and news related to that company. My philosophical investing approach into this month will again be sitting at around 60% cash reserve, and this is due to the uncertainty of events we're about to see. I will be keeping my positions in Waiters, JPMorgan Chase, Uber, Slack, and Square, but I may consider exiting my position with Alibaba based on the whole US-China tensions on the new securities law and potential price fluctuations. I do plan on exiting my position if it reach a price target of $189 and hope to buy in again at around $150 and $150 range. With Jerome Powell opening his mouth once again this Friday, it'll be really interesting to see what he has to say about interest rates and updates on the HEROES Act. And as the head of Federal Reserve, he has more influence over the US dollar value and the stock market more than anyone else. Traders like you and me closely watch his speeches, as they often used to drop hints regarding future monetary policy. So going back again to my current portfolio, number 3 on the list, we have Mr. JPMorgan Chase. Recently, I picked up 10 shares with an average cost of $93.57. And going back to 2008, compared to the banks like Wells Fargo, Citi, and Bank of America, JPMorgan Chase actually handled the crisis the best and performed the most profitable. And this is ultimately in line with their balance sheet and proper risk management in place. They did announce that it's allocating big reserves for the next 3 to 6 months because they understand that it'll be tough for small businesses and consumers to pay back their loans or credit card. While on its first quarter earnings statement showed that its credit reserves increased by $6.8 billion from the prior year. Now, that is a really smart move on Chase side, and it will be really interesting to see how this play will play out in the near future. And the reason we saw a surge in bank stocks this week is due to the fact that the market is optimistic on economic recovery. With Donald Trump pressuring states to reopen businesses, it is likely that we will see an increase in economic activity, which means people are going back to work, in turns meaning consumer spending will see an increase. Officials in all 50 states have already relaxed earlier restrictions to some extent. In Hawaii, we are seeing the mall opening once again, along with beaches where people are practicing social distancing. That's social distancing for y'all. Before getting to number 2 on my list, I would like to point out that it's important for you to do your own personal research. I'm not telling you rather these stocks are a buy for you. I'm just basing this entire video on exactly what I personally did or about to do for myself. So number 2 on the list is Carvana, ticker symbol CVNA. Carvana is in the business of e-commerce, on selling and buying used cars in the United States. Some of the things that separates Carvana from its competitor is its 7-day return policy, the free as soon as next day delivery to individuals within 100 miles of their market, and the time you'll save by skipping the dealership entirely and buying a car online with Carvana. It's fast and offers a convenient experience for buyers and sellers, essentially playing the middleman and facilitating the deal of any transactions. It's a platform that offers research and helps identify any vehicle inspected using proprietary 360-degree imaging technology. It also helps with finding the best financing option and warranty coverage, as well as scheduled delivery and pickup due to the touch of your fingertip online. While the company is still in the early innings of the long-term growth story and has plenty of new opportunities, one fantastic example is its recent trend of purchasing consumer vehicles, even if those consumers weren't buying a vehicle from the company at the time. That sounds boring, but reselling consumer purchased vehicles is more profitable than selling vehicles purchased from auction. And this strategy has taken off. Carvana's consumer purchase vehicle went up by 232% during the first quarter of 2019, representing 40% of retail units compared to 24% of the total retail units in the year prior. And while doing so, I do recognize a very similar strategy that Carvana is deploying as compared to Amazon, which is educating and changing online experience for cars. Disrupting this industry will hopefully lead to a future acquisition of Carvana once it's proven to reach profitability and proven to their market with their innovation and infrastructure. Carvana is currently trading at a roughly $96. It was down to the lower 30s at one point in late March, but quickly recovered like a V-shape back a couple months later. They are a $16.3 billion market cap company. And as you can see here in 2017, the year that they went public, it is only operating mostly in the East Coast, but slowly after 3.5 years, fast forward today, look how far they have grew. And this doesn't even include the recent announcement that it has made on its website that will be launching into 100 new markets to bring online car buying and touchless delivery to customers who need it. However, we do see 34% of float shorted, meaning 34% of Carvana stock has been bet against by traders and institutions compared to the number of shares issued. This presents opportunities as a short squeeze can also happen when a heavily shorted stock starts to rise and short sellers started buying to cover their positions and cut their losses, which does lead to a bigger push in price increase. So at the end of the day, Carvana is definitely a stock to watch for this month. And last but not least, number one on the list, Virgin Galactic, ticker symbol SPCE. SPCE space was popping off earlier today because of the SpaceX launch was supposed to happen. However, they did postpone it to another day due to bad weather. They are planning to reschedule to launch this upcoming Saturday. Virgin Galactic is in the business of commercial aerospace. Again, another disruptive industry in which only a few companies have the balls to get into. And their big idea is to send regular people into space for a hefty fee. The flight is to last around 90 minutes as one would expect. Celebrities and other mega rich folk will go first, with the likes of Justin Bieber and Leonardo DiCaprio having already reserved out a cool $250,000 for tickets. And just imagine Justin Bieber and Leonardo in the same spaceship. Now, how cool would that be?
The fucking phone, idiot.
Another reason why I'm optimistic and excited for this company is the fact that Chamath Papaya is a huge investor and has helped take this company to public with a 49% stake. And any type of investment Chamath put his hands on, it always has this tendency of turning into gold, just like the Golden State Warriors. Here's a small clip of Chamath speaking about Virgin Galactic.
This thing looks like a software business under the hood, even though it's flying people to space. So this is, I think, actually a really compelling risk reward. I mean, even taking a general step back, I think I've had a really good track record right now of being a little bit ahead of some big trends, whether it was a transition to Amazon, whether it was backing Bitcoin, things like Slack. And what I'll tell you is I generally don't put my own principal capital on the table unless I think there's a really compelling risk reward, and I'm doing that here.
But on the other side of the table, things aren't looking as bright. We have CEO Richard Branson sell $500 million of his stake in Virgin Galactic, which are used to support and maintain his other traveling business ventures due to COVID. When the company reported its most quarterly results, Virgin Galactic missed on earnings and beat on revenue. However, there was a line in the press release that caught investors' attention. It reads, entered into Space Act agreement with NASA to facilitate the development of high-speed technologies. While Virgin Galactic is working towards space tourism, it looks like high-speed travel around the world seems to be a more feasible type of business. And because of that, I am looking to buy roughly 150 shares if it stays above the target price of $17. So now moving into the chart, the stock did seem to drop to $16.70 after the announcement of the launch. However, it seems like it is finding some sort of support at $17, which is actually really good. Also, it does look like the RSI is hitting its support and most likely to reverse to the upside, which does indicate a bullish sign for this company moving forward. I would pay very close attention to what happens during or after the launch on Saturday before pricing in. Well, I hope you guys enjoyed this video. Let me know down in the comments below what you guys think. Would you guys invest in any of these stocks that we just went over? And if so, why or why not? Again, thank you guys for supporting this channel. I'll see you guys soon. Avocado.